Welcome to the May 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV, Global Market Sentiment and Risk Assessment. The Asset Allocation Committee meeting in May 2025 revealed a dramatic shift in market sentiment compared to the previous month. MAV highlighted how the most recent Bank of America Fund Manager survey showed a significant change in outlook, with the proportion of managers expecting a hard landing, defined as a recession severely impacting earnings, dropping from 49% in April to 26% in May. This shift reflected growing optimism across investors following the dramatic announcements of April 9th and subsequent positive economic developments. The improved sentiment was further evidenced by Yardeni Research's revised recession probability indicator, which decreased to 25%. This adjustment came after initial concerns about the severity and broad scope of the early April announcements had moderated. The committee noted that their previous 50-50 recession probability assessment may have been optimistic given the initial scope of proposed measures, but subsequent developments, including the US-China trade deal, had improved the outlook. Goldman Sachs's current earnings forecasts presented a more measured view compared to market consensus. They now project 7% S&P 500 earnings per share growth for both 2025 and 2026, which is below previous estimates suggesting double-digit growth and the current bottom-up analysts' predictions of 14% growth for 2026. The committee suggested that if Goldman's more conservative projections proved accurate, current market valuations could face challenges. The negative first-quarter GDP print was discussed in detail, with Stephen Duchesne highlighting the significant impact of import surges on the figures. The committee explored the technical aspects of this decline, particularly the role of Free Trade Zone (FTZ) warehouses in the United States. These FTZs allowed major retailers like Walmart and Amazon to potentially stockpile inventory without immediately paying tariffs, creating a complex dynamic in trade flows and GDP calculations. MAV emphasized that the GDP contraction of 0.1% was primarily driven by inventory effects and changes in household consumption patterns, with consumer spending contributing only 0.3% to overall growth. The committee viewed these changes as largely anticipated and temporary, reflecting intertemporal shifts in spending patterns rather than fundamental economic weakness. This interpretation was supported by the fact that domestic final demand remained positive at approximately 0.6%, suggesting the broader economy was not experiencing severe deterioration. The overall assessment suggested that while recession risks had moderated, the committee remained vigilant about potential challenges, particularly regarding inflation pressures and the sustainability of current market valuations. The dramatic shifts in sentiment and economic indicators highlighted the complex interplay between policy decisions, market expectations, and economic fundamentals in shaping the current market environment. International trade dynamics and US-China relations. The committee's analysis delved into the evolving trade relationship between the United States and China, highlighting significant structural changes in global trade patterns since 2019. MAV presented data showing Chinese exports in April increased by 8.1%, substantially exceeding consensus expectations. However, this figure needed to be contextualized considering broader concerns about Chinese economic transparency, as highlighted in a recent Wall Street Journal report indicating that Chinese officials had ceased publishing various economic data points without explanation. The discussion highlighted growing concerns about China's economic stability, particularly in its real estate sector, which some sources describing it as crumbling. Reuters reports suggest Chinese officials were alarmed by increasing bankruptcies across the manufacturing sector, including furniture and textiles. This economic pressure potentially explained China's willingness to accept asymmetric tariff arrangements, a 10% tariff on US imports versus a 30% tariff on Chinese exports. The analysis of trade flow data from 2020 onwards revealed significant shifts in Chinese export patterns. China has strategically redirected exports toward Latin America, ASEAN regions, and Africa in order to reduce the dependence on traditional markets like Japan, the US, and Europe. This shift became particularly pronounced in early 2025, with US-bound exports experiencing a sharp decline. The ASEAN region notably absorbed much of this redirected trade volume, suggesting a strategic realignment of supply chains. Kingsley Jones provided some context regarding trade intensity, noting that 86% of Chinese exports by value went to destinations other than the US before the trade war. This highlighted the US market's relatively limited importance to Chinese export success. The committee also discussed the strategic significance of rare earth exports, which had declined by 15% in April, potentially relating to newly unveiled export restrictions, while it has also likely influenced both nations' willingness to reach a trade agreement. The discussion emphasized how these trade dynamics reflected broader geopolitical shifts, with both nations attempting to maintain economic leverage while avoiding mutually assured economic destruction. The committee noted that this complex trade picture was occurring against a backdrop of changing global supply chains and regional economic integration, particularly through agreements like the Regional Comprehensive Economic Partnership in the ASEAN region. Monetary policy and inflation dynamics. The committee engaged in a detailed analysis of monetary policy expectations and inflation dynamics, focusing on both current indicators as well as longer-term structural shifts. The latest US CPI data showed annual headline inflation at 2.3% year-on-year, with the annualized seasonally adjusted inflation at 2.6% and core inflation at 2.1%. However, MAV expressed significant concerns about the inflation trajectory for the latter half of the year, particularly around the Christmas period and early 2026. The discussion highlighted a critical observation regarding price pressures being initially absorbed by producers rather than being passing through to CPI, suggesting potential margin compression that could ultimately impact corporate earnings. This analysis supported Goldman Sachs's more conservative earnings growth projections and raised questions about market valuations, particularly if accompanied by higher inflation expectations. The Federal Open Market Committee, FOMC, rate expectations have seen significant revisions since the last meeting, with market predictions shifting away from multiple rate cuts in 2025. While the committee previously maintained a base case of no further cuts, recent developments had introduced more uncertainty. Market expectations for rate cuts by October and potentially another by Christmas were viewed skeptically, especially given Chair Powell's recent comments about elevated risks to both growth and inflation. The yield curve dynamics showed significant movement, with Australian 10-year yields reaching 4.52% while US 10-year yields were 4.55%. The committee also noted a nearly 70 basis points term premium, with this likely reflecting growing inflation concerns following the US-China trade deal. Both real yields and break-even inflation rates have been trending upwards over the last 6 weeks, suggesting markets were pricing in higher inflation moving forward. The Australian interest rate landscape provided an interesting contrast, with inflation expectations moderating due to robust labour market conditions that hadn't translated into significant wage pressures. This was attributed partly to lower fuel prices and government subsidies. The Reserve Bank of Australia is expected to implement a rate cut at its next meeting, reflecting diverging monetary policy paths between Australia and the United States. Strategic global power realignment and investment implications. The committee dedicated significant attention to analysing what MAV termed an implicit Mar-a-Lago Accord, drawing parallels with historical agreements like Bretton Woods and the Plaza Accord. This analysis positioned current developments within a broader historical context where the US endeavours to maintain global economic dominance. The committee noted how previous agreements, including Nixon's closure of the gold window and the Plaza Accord, were strategically designed to entrench US power, often at the expense of competing economies. The current strategy appears to involve coercive diplomacy through tariff threats, which has been particularly evident in dealings with Japan regarding its US Treasury holdings and potential automotive sector tariffs. The US approach aims to reclaim competitive advantages across multiple sectors, especially in technology and strategic industries. This included efforts to revitalise domestic manufacturing, though Kingsley Jones expressed scepticism about broad manufacturing resurgence outside specific sectors like semiconductors, weapons, and pharmaceuticals. The committee identified several key elements of this strategic realignment: a potential 30% real dollar devaluation without the typical negative consequences, increased global defense spending benefiting the US military-industrial complex, and targeted corporate tax incentives for industrial and high-tech sectors. The timing was considered crucial, with the Trump administration likely to pursue aggressive policy implementation before potential changes in congressional control following the next round of midterm elections. Investment implications were substantial, with the committee identifying several slack variables warranting attention. Gold was highlighted as a crucial hedge during periods of exceptional uncertainty, particularly when bonds couldn't fulfill their traditional safe haven role due to inflation concerns. The euro was identified as another key variable, having shown a substantial appreciation despite the US's attempts at currency control. The committee concluded that the US 10-year bond rate represented a potential Achilles heel in this strategy, with yields surpassing previous panic levels. That is, April 9th, when the 90-day implementation pause was announced. This created a complex investment environment where traditional asset relationships might not hold. The analysis suggested that while the US might achieve some strategic objectives, unintended consequences could include a widening trade deficit and see a strengthening of regional economic blocs attempting to resist US coercion, particularly in Europe and Asia. The discussion emphasized that these structural changes required a fundamental reassessment of traditional investment approaches, including hedging strategies. The committee planned to revisit hedging policies in their June meeting, recognizing the need to adapt to this evolving global economic architecture. Now we welcome our first guest speakers, Sasanka Leonaj and Annabelle Nash from Charter Hall, providing an update on the property sector, commercial real estate market repricing and recovery. The session focused on Charter Hall's analysis of the commercial real estate sector, with Sasanka Leonaj and Annabelle Nash providing detailed insights into the market's evolution. The sector has emerged from its largest repricing correction since the global financial crisis, driven primarily by the rapid rise in interest rates. However, the market has now begun to show positive signs across multiple metrics. The correction's magnitude varied significantly across sectors. Office properties have experienced the most substantial decline, with values falling between 20 to 25%. The retail sector, which has been adjusting since 2018 following Amazon's entry into the market and subsequent COVID-19 impacts, saw a more modest 8 to 10% decline. The industrial sector experienced approximately a 10% correction, similar to that seen in the retail sector. These adjustments were primarily driven by yield movements, with office and industrial sectors seeing approximately 180 basis points of expansion. Market confidence has improved as capitalization rate compression for high-quality real estate returns, suggesting an inflection point may have been reached. Transaction evidence and valuations also indicate a potential compression in yields by the end of 2025, earlier than previously anticipated. This optimism is partly being fueled by strong disinflationary trends and downwardly revised cash rate expectations, with forecasts suggesting a terminal rate closer to 3% by year-end, down from previous expectations of 3.4%. Capital values growth has moved into positive territory according to MSCI data, with growth predominantly led by the government sector. The corporate sector has recently shown increased activity, suggesting private sector participation in the growth story is set to expand. However, a notable trend has emerged in investor preferences, with strong demand for high-quality cash flows secured by well-rated tenants such as government entities such as Australia Post and high-quality corporates like Wesfarmers. The capital intensity of assets has become an increasingly important consideration for investors who are now seeking to minimize cash flow leakage. This is particularly evident in the office sector, where rental growth in premium-grade assets has reached its fastest pace since 2018. This growth has occurred despite elevated vacancy rates, which represents a disconnect from historical relationships between vacancy and rental growth, primarily due to construction cost pressures and increasing tenant preferences for higher quality space to incentivize a return to the office. Office sector dynamics and structural changes. The office sector has seen significant structural changes in workplace dynamics and tenant preferences. The post-pandemic period has been characterized by unprecedented uncertainty, leading to the largest valuation repricing since the GFC. However, recent leasing activity has seemingly dispelled concerns about the death of the office, as there has been an increased uptake of space in prime office buildings, demonstrating a clear flight to quality. Australia's strong population growth, running at 15% over the previous decade and tripling the G12 average, has emerged as a key driver for office demand. The committee noted projections indicating approximately 3 million square metres of new office space would be required over the next 5 years to accommodate white-collar employment growth alone, a figure exceeding the current size of Brisbane's CBD office market, 2.3 million square metres. Additionally, the growth in AI and technology-based jobs was expected to require an additional 1.3 million square metres of space. Infrastructure improvements have significantly impacted office attendance patterns, with Sydney recording an increase in weekly office attendance to 82% in the first quarter of 2025, up from 77% the previous year. This has been largely attributed to the new metro system. However, the infrastructure benefits have led to a centralisation trend rather than benefiting suburban office growth, with tenants gravitating toward core CBD locations that offer superior amenities. The sustainability credentials of office buildings has become increasingly critical, with 94% of ASX 50 companies having net zero carbon commitments. However, only 28% of CBD office buildings nationally achieved a NABERS rating of 5 or above, creating a significant disconnect between corporate sustainability goals and available quality space. This has become a crucial factor in tenant decisions, particularly for professional services firms where office space represented one of the few controllable factors in their environmental footprint. The development pipeline has faced severe constraints despite strong demand signals. Construction costs have risen so significantly that rents would need to increase by 30 to 50% to make new developments feasible. This situation has been compounded by labour shortages, union issues, and extended planning processes, with Sydney expecting only 2 new developments to commence between 2025 and 2032. The situation has created a notable divergence between prime and secondary assets, with high-quality space experiencing growth while secondary space contracted. Industrial and logistics sector evolution. The industrial and logistics sector has demonstrated remarkable resilience and transformation, characterised by historically low vacancy rates of approximately 2.5% nationally, with this dropping to 2% in key markets like Sydney and Brisbane. The sector's evolution has been driven by multiple structural factors, including the acceleration of online retail penetration, population growth, and a fundamental shift in supply chain strategies. The post-pandemic period has witnessed a significant emphasis on supply chain resilience, with occupiers increasing their inventory levels within Australia to mitigate future disruption risks. This strategic shift from just-in-time to just-in-case inventory management has been temporarily relaxed but could return as a priority, particularly in the event of escalating global trade tensions. The committee noted emerging evidence of Chinese third-party logistics providers seeking space in Melbourne. potentially indicating a strategic response to trade redirection and could point to possible disinflationary effects from tariff-related trade adjustments. Supply dynamics have shifted considerably, with projected new supply for 2025 expected to reach approximately 2.2 million square metres, representing a substantial decrease from the previous year's 3.5 million square metres. Despite moderating construction costs in the industrial sector compared to office and retail, development constraints persisted, primarily due to land availability and infrastructure requirements, particularly in greenfield locations where power, water, and road access presented significant challenges. The sector has experienced a notable bifurcation in demand, with occupiers demonstrating a strong preference for modern, well-located facilities capable of supporting automation and enhanced operational efficiency. This trend is evidenced by strong pre-leasing activity, with approximately 80% of new supply in the previous year being committed prior to completion. The emphasis on automation and efficiency has been driven by the recognition that transportation and labour costs represented approximately 80% of occupier operating expenses. This has resulted in higher rents for premium locations and the provision of specifications that could deliver operational savings and sustainability benefits through reduced transportation requirements. While the explosive rental growth of 20% seen in recent years has moderated, the committee anticipated a normalisation rather than a collapse in rental rates. The sector's fundamental drivers remain robust, although uncertainty around supply chain reconfigurations and potential global trade developments continue to present both challenges and opportunities for the sector. Retail sector transformation and market positioning. The retail sector has demonstrated unexpected resilience, achieving its strongest outcome since 2018, seeing it deliver the highest returns among all commercial property sectors over the previous 12 months. This performance was particularly noteworthy given the sector's historical challenges, including the impact of e-commerce growth, COVID-19 disruptions, and inflationary pressures. A clear bifurcation has emerged between discretionary and non-discretionary retail assets. The non-discretionary segment, anchored by supermarkets and essential services, has demonstrated superior stability in cash flows and lower volatility in risk-adjusted returns. This segment has benefited from higher initial capitalization rates, requiring less adjustment during the recent correction period, while also demonstrating lower ongoing expenditure in relation to leasing incentives and maintenance. The market has witnessed significant shifts in capital flows, with private capital and high net worth investors increasingly targeting smaller retail assets that has resulted in enhanced liquidity in this segment. In contrast, larger regional centres have faced ongoing challenges in attracting institutional capital, with major players like Vicinity and Stockland adopting polarised strategies, by expanding into both premium and discount offerings to offset economic imbalances. Online retail penetration in Australia remains at approximately 14%, significantly below the 20% plus levels seen in more mature markets globally. This gap suggests further potential e-commerce growth, particularly given generational preferences and improving technology. However, the physical retail environment has adapted successfully to an omni-channel approach, with over 80% of online retail sales being captured by existing traditional retailers in the non-discretionary sector, providing them with a competitive moat against pure-play online retailers. Foot traffic and in-store consumption has shown positive trends, benefiting from population growth, tourism recovery, and changing consumer behaviours. The retail landscape has been further shaped by demographic shifts, with initial pandemic-driven regional migration beginning to reverse as populations returned to urban centres. Melbourne, despite its economic challenges, continued to demonstrate strong population growth, driven by international migration and relative housing affordability. The committee noted that these demographic patterns, combined with limited new supply and established omni-channel capabilities, positioned well-located, non-discretionary retail assets for continued stable performance, despite the potential for consumer spending volatility. Our next speaker is Vivek Prabhu from Perpetual, who presented an update on Australian credit and income sector, credit market volatility and risk indicators. During the session, Vivek Prabhu provided a comprehensive analysis of recent credit market developments, highlighting that April 2025 had witnessed the highest bond market volatility since the COVID-19 period. A key focus of the discussion centered on the LIBOR-OIS spread, which served as a crucial indicator of banking system health, liquidity risk, credit risk, and general banking system pressures. Prabhu highlighted significant historical correlations between elevated LIBOR-OIS spreads and market stress events. The spread has shown notable peaks during the Russian invasion of Ukraine in March 2022 and the Silicon Valley Bank collapse, Duchesne Credit Suisse crisis in March 2023. However, by the end of 2024, the spread had exceeded both these previous peaks, signaling increasing pressures within the system despite no immediate apparent crisis. The analysis of credit spreads revealed that high-quality credit in the AA and single-A bands had been trading at decade lows prior to April's volatility. Similarly, BBB credit spreads were at the lower end of their historical range. These outcomes were a result of investment-grade spreads, tightening by approximately 50 basis points the last couple of years. The committee noted significant regional variations in credit spread behavior. US investment-grade and high-yield spreads had been trading tighter than pre-GFC levels before April, making them look expensive when compared to Australian and European spread. However, the April volatility had altered these relationships, with European credit spreads becoming relatively expensive compared to Australian spreads, while US spreads had returned to their previous levels after initially widening, making them look less expensive. The discussion highlighted the emergence of new patterns in international issuance, as highlighted by Queensland Treasury Corporation's first-ever euro-denominated bond issue. This move reflects the challenges state governments face in finding marginal buyers beyond traditional bank holders. This development was seen as particularly significant given the increased funding requirements of Australian state governments and their need to diversify funding sources, Australian inflation and interest rate outlook. The committee's discussion turned to domestic inflation and monetary policy expectations, with Prabhu providing a detailed analysis of the Australian economic landscape. The services sector has been identified as the last bastion of elevated inflation, though recent CPI readings had finally shown signs of moderation in this area. This development was viewed as particularly significant given the persistent nature of services inflation throughout the post-pandemic period. Market pricing has incorporated expectations for approximately 3 Reserve Bank of Australia rate cuts by the end of the calendar year, though Prabhu suggested this might be overly aggressive, proposing 2 cuts as being more likely. This outlook was primarily attributed to the federal government's strengthened majority position, which increased the likelihood of significant fiscal spending plans being implemented. These spending initiatives were seen as potentially constraining the RBA's capacity for monetary easing. Regarding sovereign bond yields, Prabhu identified 4.5% as a critical threshold for the 10-year Australian government bond, viewing yields above this level as attractive value. This view has seen him undertake a number of purchases when yields exceeded this level in recent days. Semi-government bond spreads have experienced notable widening over the course of 2025, with 10-year New South Wales Treasury Corporation and Queensland Treasury Corporation bonds showing spreads over Australian government bonds in the mid to high 90 basis points range. This widening was attributed to both increased government spending expectations and ratings agency concerns, with recent announcements by the rating agencies interpreted as a warning signal as to their future fiscal discipline. The committee noted that spreads had subsequently moderated to the mid to high 80s basis points range. The intersection of fiscal and monetary policy attracted particular attention, with the committee examining how increased government spending might impact both inflation dynamics and yield curves. The potential for fiscal expansion to create upward pressure on yields was considered, especially in light of recent rating agency responses to state government spending patterns and their implications for credit quality. Fixed versus floating rate securities analysis. The committee engaged in a detailed analysis of the structural shifts in fixed income markets since the pandemic, with particular focus on the comparative performance of fixed and floating rate securities. Prabhu highlighted that fixed-rate bonds had experienced challenging returns over the previous 4 financial years, either delivering negative returns or failing to exceed the level of core inflation when returns were positive. The fixed-rate bond index had recorded losses of 0.8% in fiscal year 2021 and a substantial 10.5% decline in fiscal year 2022. A fundamental change in market dynamics was highlighted notably in relation to the break-even levels of benchmarks. Pre-GFC, when 10-year government bond yields were around 5 to 6% and interest rate duration was approximately 3.5 to 4 years. Break-even levels were in the high 100 basis points range. This meaning yields would need to rise 100 basis points before losses were made. This had shifted dramatically post-pandemic, with the 10-year yield reaching a trough of 0.8% in November 2020, while duration extended to 6.25 years. This saw break-evens reduced to just 9 PBS. The current environment, with rates around 4.5% and duration below 5 years, has improved break-even levels to 80 to 90 basis points, though this remained significantly below pre-GFC levels. The composition of fixed-rate benchmarks had also evolved, with corporate risk comprising only about 10% of indices, effectively transforming them into predominantly government bond indices and reducing exposure to credit yield premiums. Floating-rate credit instruments have demonstrated superior defensive characteristics through this period, with running yields in the high 5% range providing larger carry and better interest rate buffers against market volatility. This had resulted in real returns after inflation in all but 1 year post-pandemic. The sole negative year, fiscal year 2022, showed a relatively modest decline of 2.4% compared to the fixed-rate benchmark's 10.5% loss. Looking forward, while acknowledging the commencement of an RBA rate-cutting cycle, Prabhu suggested that even with 2 anticipated rate cuts, floating rate yields would likely moderate from the high 5% range to the mid 5% range, maintaining relatively attractive returns absent a deep recession scenario. This analysis supported the continued appeal of floating rate credit in soft landing or mild recession scenarios. Credit market structure and investment implications. The discussion concluded with a comprehensive examination of broader market dynamics and their investment implications. Prabhu emphasized a significant shift in relative value opportunities, noting that fixed income returns had exceeded ASX 200 dividend yields for the first time in approximately a decade. This occurred against a backdrop of stretched equity valuations, with US markets trading around the 95th percentile of historical PE ratios and Australian markets near the 80th percentile. The committee examined recent developments in corporate issuance highlighted by Woodside Petroleum's substantial $3 billion USD multi-tranche offering. This transaction, along with Queensland Treasury Corporation's inaugural euro issuance, demonstrated the increasing attractiveness of offshore markets for Australian issuers. The pricing differentials between domestic and international markets had created opportunities for issuers to optimise their funding costs while providing investors with geographic diversification opportunities. State government financing has emerged as a critical theme, with particular attention paid to Victoria's fiscal position. The committee debated the notion of implicit Commonwealth support, noting historical precedents and official positions regarding the absence of formal guarantees. This discussion highlighted the complexity of pricing semi-government securities, especially given increased state government funding requirements and the need to identify new marginal buyers beyond traditional bank holdings. The defensive characteristics of credit investments were analysed in the context of inflation protection, with Prabhu noting that floating rate products had outperformed core inflation in 15 out of 19 years of historical data. This performance was attributed to the strong linkage between inflation and cash rates, Though recent RBA commentary suggested careful consideration of market pricing for rate cuts against their mandate to target the middle of the 2 to 3% inflation band. The committee concluded that the current environment presented compelling opportunities in fixed income, particularly given elevated equity valuations. However, security selection and careful consideration of duration and credit risk exposure remained crucial, with floating rate credit continuing to offer attractive risk-adjusted returns in most scenarios short of a deep recession. With that, we can now move on to summarize all the discussions and frame a portfolio construction strategy. The committee discussed several key market themes, with particular focus on commercial property and real estate dynamics. Rising replacement costs of real estate assets were highlighted as a significant factor supporting capital values, despite some market volatility. The domestic economic outlook remained relatively weak, with energy costs and gas prices emerging as major concerns for Australian businesses. Employment data showed continued strength with 89,000 new jobs added, mostly full-time positions, maintaining the trend unemployment rate at 4.1%. The committee noted that interest rate expectations had shifted, with predicted rate cuts reducing from 5 to 3, influenced by strong economic data, particularly from the US. The committee maintained a cautious approach to portfolio positioning, with no immediate changes recommended to asset allocation. They expressed comfort with being underweight in both Australian and international property, preferring infrastructure exposure for similar returns with less volatility. Discussion focused extensively on gold positioning, with central bank buying behaviour, particularly from Poland and China, supporting the asset class. The committee noted that gold served as an effective hedge against uncertainty and provided a solution for central banks looking to diversify away from US Treasuries without strengthening their domestic currencies. Members agreed that while gold prices might experience volatility, underlying support from central bank buying was likely to continue in the medium term.